look to potentially, maybe the worst is now actually behind these stocks from an earnings standpoint, a multiple correction standpoint, and then obviously a stock performance standpoint? From an earnings standpoint,
I think the enthusiasm for the Mag 7, Scott, has been rooted in part by their willingness to invest and by the capex that they have put forth in order to create a growth trajectory and a growth expectation for the next 5 years. So I think, perhaps that value of that is not quite as dear in an environment where you expect capex to grow across other industries into this environment. And so, for us, we're still not as optimistic or constructive on these names. We like the technology sector outside of the Mag 7, but for us, we like the increase in capex across other industries to create that same sort of growth enthusiasm, albeit perhaps not at the same absolute earnings levels.
What about, and lastly to you, the momentum correction? Is that done, do you think?
So.
Is it important that it's done? The market was having a really hard time getting anything going as long as those stocks were pulling back as strongly as they were.
I think the transition from one regime to the other typically takes a little bit of time. And so if we're going to shy away from some of the momentum names on the smaller end, the Robinhoods, the Carvanas, the Palantirs that we talked about, on the larger end, the AI semi-names, the transition from that to some other theme would presumably take place over certainly several months, if not a few quarters. But again, getting back to the point that I just made, and I think Shannon wouldn't necessarily argue with, I don't know why, if that was your trade 3 months ago, 6 months ago, it wouldn't be your trade now. They still have superior earnings growth, mostly. Obviously, Apple and one or two.
Well, their multiples arguably got way ahead of where their earnings and earnings growth was.
And they've come down considerably. They appear to be bottoming. Not everybody, but they appear to be bottoming.
That's the key question. I mean, had the multiples corrected enough to get back in line with their fundamentals?
Yeah, I mean, listen, the market tells you when enough is enough. I think that the charts on a lot of these names tell me that we seem to be, listen, you've got the macro that I talked about earlier, you've got the micro, you've got the Morgan Stanley note. I think you've got a feeling that, like, fundamentally the earnings haven't been impaired at all, which was just mentioned. The market's still looking for roughly the same level of EPS over the next 4 quarters now than it was at the peak. So I think when you put it all together, and again, it's not what I do, but I think if that was your trade before, I think it's still your trade now. The only thing I would add is, like, our favorite space, which has been energy for some time now, is leading this year. And a lot of the retail names outside of Amazon and I guess Deckers, which is doing terribly, there's plenty of consumer-focused names that we talk about and look at that are doing fine. There are other themes there, but again, in terms of driving performance, it's hard to argue with the growth rates for a lot of those companies.
We will leave it there. Dan, thank you. Stephanie, thanks to you as well. And Shannon, of course, we'll see you soon. We are just getting started here on The Bell. Up next, star analyst Mike Mayo is forecasting some serious upside in one big bank. He tells us what it is next.
Insurance.
JP Morgan shares rallying again after posting their best week in some 2 months. Our next guest calling for more than 20% upside from here. He raised his estimates just today. Let's bring in top banking analyst Mike Mayo of Wells Fargo Securities. He's here at Post 9. It's good to see you.
Nice seeing you.
So last week you called JP Morgan the NVIDIA of banking, and today you followed through by increasing your estimates and reiterated it as your signature pick. Why? Why all this love for JPM?
Well, I had a conference last week, Wells Fargo's research group. We had all sorts of big tech firms there. We had Amazon, Microsoft, Meta, NVIDIA. And you know what was interesting about that conference was the praise JP Morgan got from big tech. So JP Morgan is the NVIDIA of banking, and you're seeing growth in their consumer checking accounts 2 to 3 times faster than the industry. So that's over the next 1 to 5 years. But let's talk about the next year. And so we updated our earnings estimates, and JP Morgan reports earnings for the first quarter 2 weeks from Friday. And I think those earnings will be strong. In addition, we upped our estimates for the next couple of years because JP Morgan is one of the biggest beneficiaries of deregulation. So you have Goliath is winning when it comes to tech and their share gains. You have trading and strong earnings coming ahead, and one of the biggest beneficiaries of deregulation. So people are looking at, little pieces of the market and banks, and they're missing the seismic shift that's taking place at JP Morgan, best-in-class global bank that's expanding its lead.
Yeah, where's all this deregulation, though? Where is it?
People tend to overestimate deregulation in the short term and underestimate it in the long term. This is just like what I saw in the mid-1990s. No one cared until they were forced to care. So as you get people, you get policies, and as Scott Bessent has said, he wants to have more efficient regulation, more effective regulation, and empower banks more. So just listen to the Treasury Secretary. And Scott,
I know what they're saying, but where is it? And how patient are you going to be that it actually arrives? I go back to what I said to our other guests at the beginning of the program. This was one of the hallmarks of this administration coming in. Granted, it's only March, okay? But with all the tariff twists and turns, the good stuff, as I phrased it as earlier, tax cuts, deregulation, just keeps getting pushed further and further.
So look, I've been in about 12 countries in the U.S. and Europe the last 2 months. The biggest pushback was the, quote, chaos. The chaos was so much policy uncertainty at the same time. So the investor sentiment was like, we're going to step aside from the chaos until it resolves itself, and then we'll step back in. And if we're having this conversation as July 4th, Scott, then forget the bank thesis, forget the thesis, because right now you have a degree of paralysis for big mergers, for big CapEx spending, and that propels capital markets and lending fees and lending revenues and things like that.
So you think it's still a risk?
It's absolutely a risk. This is a critical junction right now, critical juncture. Like the Washington, D.C. needs to resolve the policies so the participants know the rules of the game. And if you don't know the rules of the game, then people are going to step aside. So I think, you know what my analogy here is, Scott? When Jamie Dimon took over as CEO, the first thing he did is he highlighted all the bad things. He brought them out in the open, and he said, we're going to deal with that. And there might be some pain, there might be a transition period, but that will create longer, higher, sustainable returns. So it's kind of like that, short-term pain for long-term gain. The problem is there's no one Jamie Dimon to execute it, so that's the key risk, execution. But I think in Scott Bessent, we trust. The Treasury Secretary has set a tone for financial discipline. In fact, if you want to go way back in time, maybe Scott Bessent can become the Albert Gallatin of Treasury Secretaries. He was the Treasury Secretary under Thomas Jefferson. He actually had a surplus. He helped create a surplus. So we're talking about reducing the deficit in half as a percentage of GDP. So lower rates, deregulation, and you're already having inflection at banks in revenues, efficiency, and returns. And EPS was negative the last 3 years. We think it's going positive. The deregulation is just icing to a good bank story.
In all seriousness, the lack of M&A, lack of capital markets activity, new numbers today, lowest in more than a decade. Deals announced since the start of January. That's according to Deal Logic. I mean, there's not a lot of optimism on that front. There was, but now we're kind of wondering, okay, well, maybe we need to rethink it, at least in the near term.
it has challenged my conviction. Don't get me wrong. And my earnings estimates are at risk. JP Morgan might be an exception. I think some of the big banks trading is doing well. But my earnings estimates are at risk. It's challenged my conviction. I do think rational minds will prevail over the next couple months. And if I'm back here July 4th talking to you, Scott, and we're still having the same discussion, it's a different story.
And Citi is still your number one pick.
Citi still,
as much as you love, JPM and Jamie and all that, and NVIDIA banking, Citi is still your number one pick.
Citi will transition from value destruction to value creation by next year. And if they do that, then they go from below tangible book value to above tangible book value. We have Citi doubling over the next 2.5 years.
All right, we'll leave it there. Mike, good to see you as always. That's Mike Mayo, Wells Fargo Securities, right here, Post 9. Up next, Mohamed El-Erian of Allianz will join us. He'll tell us where he sees stocks heading from here and if today's bounce is sustainable. He probably has some opinions on what the Fed's going to do about all this as well. We'll ask him next.
.com.
All right, we are back as stocks continue to bounce higher today. Our next guest, though, says not all clear just yet. Mohamed El-Erian, as Allianz Chief Economic Advisor, joins us now. It's good to see you again.
Thanks for having me, Scott.
I'd love to get your current view of these markets.
So the good news is we got some pretty nasty technicals behind us. The markets came into this year, as you know, betting on two things. One is continued U.S. exceptionalism, and two, the good things, as you put it, would happen at the same time as the less good. And those two bets were undermined and caught quite a few people overexposed to the U.S. markets. So you've seen quite a deleveraging among fast money, and you've also seen a shift of institutional to Europe. I think most of the deleveraging is behind us. The shift to Europe isn't quite behind us, but the technicals certainly are not as bad as they were a few weeks ago.
So, I mean, you think this U.S. exceptionalism theme is still a thing? Because I can't tell you the number of people who come on the network, certainly my programs, and talk about better value in Europe. You're going to get way better returns over there. You're probably going to get a little less risk as well. How do you see that?
So I don't quite buy that, because people have bought into announcements in Germany. Implementation is a completely different kettle of fish. So to go from announcement to implementation is quite hard. I also think that the inherent strength of the U.S. economy and the U.S. markets are still there. There's this massive cloud of uncertainty over them right now. But if and when that cloud clears, people will focus back on the inherent strengths.
What was your takeaway from the Fed meeting last week? We still have two cuts on the table. You take the growth forecast down, you raise the inflation forecast a bit, and for now it appears that the Fed chair is going to look through any inflation caused by tariffs. They even brought out the transitory word again.
They did. So you had two different interpretations. If you focused only on the statement, the forecast, and the interest rate guidance, this is a wait-and-see Fed that is taking seriously the soft data. And it is the soft data that has been worrisome. If you listen to Chair Powell, this is someone who doesn't take the soft data as seriously as the rest of the Fed. And this is someone who's willing to dismiss the tariff effects on inflation as transitory. You know, it's up to you which one you focus on. I think you should focus on the first one. I think the market still believes that we're going to get more cuts than we will. I think at best we will get one cut, and it wouldn't surprise me if we get no cuts this year, Scott, unless we go into recession. But that's a completely different ballgame.
I mean, 1 versus 2, I could see some wiggle room there. In terms of the soft data, I wonder what you do think about that, a number of the surveys, consumer especially related surveys, have been weak, which the Fed chair really dismissed. And I think that's what you're alluding to. It's like I'm not going to pay so much attention to a survey that says I feel bad about the economy until I actually see it show up in the hard data where people are, in fact, spending less. It's not something to clearly worry about. Are they too dismissive of the so-called soft data?
They are, Scott. When people say, I see it in the soft data, but I don't see it in the hard data, well, there's a lag. There's normally a lag of 3 to 6 months. You may be continuing to invest, you may be continuing to buy, but if you get more and more worried, the soft data is going to flash yellow, and the hard data will pick that up in a few months. Same with the price data. So if you look at surveys of inflation, again today we had another one, they are all consistently pointing to inflation going up. So I think the Fed should take it more seriously. The trouble is it puts their two mandates into competition. Do they fight the fear of high unemployment, or do they fight the fear of higher inflation?
Yes, but they seem, judging the words of late, that they might be willing to tolerate continually sticky inflation, or at least above target, but they're not going to tolerate any further falling apart of the economy and or the labor market. Is that correct?
I think that is correct, and I think that's the right thing to do. The 2% inflation target is arbitrary, and there's no point in pushing this economy into recession for an inflation target that and they're not going to do this, Scott, but if you were to revisit the appropriateness of this target, you wouldn't choose 2%. So I think you're absolutely right. They will err towards protecting the employment mandate as opposed to the inflation mandate.
Lastly, what do you make of the balance sheet move? I thought that was interesting in the way that Chair Powell mentioned some tightness in money markets. You've seen some spreads widen a little bit, high yield and otherwise. Nothing to, start the alarm and the siren, spinning. But what is your general thought on how they've made that move, which I think the chair pretty much called a no-brainer or something of the like.
Yeah, I think it was a smart precautionary move. Did they have to do it? No, but they did it as a precaution because the last thing they want is for markets not to function well. You know, we used to have three things underpinning the economy: confidence in policy, confidence in exceptionalism, and confidence in the well-functioning of markets. The first two have been shaken. The last thing you need is the third one to be shaken.
He called it common sense. I said the no-brainer, but he said common sense. But you know what I mean. Mohammed, I always like speaking with you. Thanks for spending the time with us. We'll see you soon.
Thanks for having me, Scott.
All right, Mohammed El-Arian. We do have some breaking news regarding Tesla. We want to get back to Phil LeBeau with the details here. Phil?
Scott, take a look at shares of Tesla. The FBI has confirmed that it has launched a task force in conjunction with the ATF that will be looking into the vandalism, the attacks, the criminal activity that has been targeting Tesla over the last couple of weeks. And one of the things they're looking at is whether or not there is some broader coordination. They have referred to this as domestic terrorism. So again, Scott, you've got the FBI formally launching a task force looking into these attacks. Scott, back to you.
All right, Phil, I appreciate the update. We just follow that still obviously continuing and developing story. A big jump in shares today, up more than 10%. Phil LeBeau. Up next, we track the biggest movers into this close today. Christina Partsinevelos is standing by with that. Hi, Christina.
Well, we have a tech-turned-crypto maverick doubling down on digital gold, scooping up over $500 million of Bitcoin this week. Meanwhile, a shipping giant gets an analyst vote of confidence, proving cost cuts can deliver more than just packages. Details next.
a reality.
We've got about 15 to the bell. Back to Christina now for the stock she's watching. Tell us what you see.
Well, thanks, Scott. I'm seeing shares of Strategy, which is formerly known as MicroStrategy, jumping 9% as Bitcoin climbs to over $88,000 right now to start the week. The firm also has once again added to its Bitcoin stash, according to a new regulatory filing. As of the week, March 17th to the 23rd, the firm purchased over $584 million in Bitcoin, bringing the firm's Bitcoin holdings to over 500,000. Yes, 500,000. And shares of FedEx rising on the back of a Jefferies upgrade, even as the firm cuts its full-year forecast. Analysts upgrading FedEx to buy from hold, confident that current cost-cutting initiatives will position the firm for further profit growth. And that's why you're seeing shares up over 5.5%. Scott?
All right, Christina, thank you very much. Christina Partsinevelos still ahead. Pinterest popping in today's session. Tell you what's driving that higher. Closing bell is coming right back. of the day for stocks. Coming up next, we'll get you set up for Oklo earnings in OT. That and much more in the Market Zone, which is coming up next. All right, we're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of the trading day. Plus, a bullish call today on Pinterest. Julia Borson will give us those details. And Pippa Stevens is looking ahead to Oklo earnings coming out in OT. Michael, I'll turn to you first. The bounce continues. We're basically at the highs of the day, and it is nicely broad-based today.
It is. It's sort of a credible continuation of what I've been calling a credible bounce off of a good low. Really, the message is a 10% three-week decline when most stocks did much worse than that, based on growth scare plus max tariffs plus momentum meltdown, was a downside overshoot, at least in the short term, if we're not going to have all those things go wrong at the same time. Where does this bring us? Right now, we are at about a 2-week high. So 2 weeks ago today, 57.70, you're up almost 5% off the intraday low. So that's a decent move. We've
Nice
kind of
bounce.
hurdled the 200-day moving average again. So it all is fitting together with this idea that this process of making some peace with the fundamentals in the form of lower prices and lower expectations. Market was obviously coiled pretty tight at the lows. We've relaxed higher. I think there's still some room, even without getting too much incremental good news, to get a little higher from here, but then it becomes What are earnings going to look like? Let's make sure the hard economic data don't fail us, and all the rest of it. So again, you're still kind of monitoring for how real it is and how much power is behind it. It's while it's broad sector-wise and stock-wise, it's not one of those like everything's up a ton today. It still is a little bit selective under the surface.
Yeah. Watching the VIX too, taking a little relief there.
Yeah, there's
7%,
a definitely a relaxation trade going on in there today.
All right, Julia, tell us about Pinterest. What's happening here?
Well, Pin's shares are almost 5% higher, bolstered by a Guggenheim note upgrading the stock to buy, raising the price target to $40, saying the recent share price pullback down almost 9% this month is an attractive opportunity to invest in the still early stage global user monetization and profit opportunity, projecting monetization of the user base to grow at above market rates in the next 2 years, fueled by volume growth and also AI-enabled ad performance improvements, saying that in terms of macroeconomic-driven ad concerns, Pinterest is better positioned than others because of its focus not on brand advertising, but on direct response advertising. B of A was also out with a bullish note on Pinterest today, citing its healthy recent user data, new AI-based direct response options, easier comps, and a relatively attractive valuation. Back over to you.
All right, Julia, thanks. Julia Borson to Pippa Stevens as we wait for Oklo and OT.
Hey, Scott. Well, Oklo jumping today ahead of those results after the company said it's working with the Nuclear Regulatory Commission as part of a pre-application process for its small modular reactor. The agency will begin the review process later this month, and Oklo expects to bring its first reactor online in late 2027. Now, the results we get in a minute are just the third for the company after it went public last year via a SPAC founded by OpenAI's Sam Altman. Back in December, Oklo entered a strategic relationship with data center company Switch, but so far it hasn't inked a deal with any of the hyperscalers. So on the call, investors will be listening for updates around how the demand environment is looking and whether talks are in progress with big tech, as well as the timeline for making its Aurora reactor operational. Now, shares have more than tripled in the last 6 months in what's been a traditionally very volatile name. Scott?
Pippa, thank you. Pippa Stevens. Mike, I'll turn back to you. I'll tell you what stands out to me, and I'm sure you and many others, is Meta. Yes. It is the only mega cap positive year to date by a good amount. I mean, it's positive by 6%.
Sure.
It's up yet again today quite nicely, too. There's been something going on with that one.
Well, multiple things, I think, working in its favor, and it did not surrender most of those gains with this hefty pullback. Part of it is them seeming on the right side of whatever this latest phase of AI is going to be. Obviously, the Zuckerberg kind of getting close to the administration didn't hurt, but also it's the social media giant that doesn't seem to have much cannibalization risk as Alphabet does. So if you just look at how Alphabet has gotten super cheap, trades at a discount to the overall market as Meta has built its premium, it's almost like all that value is being transferred in the market's estimation over toward Meta. So that does make sense to me. I think the bigger question is kind of the Mike Wilson call up from Morgan Stanley today, which is that the Mag 7 or NASDAQ 100 type stocks can grab the baton for a little while here because they have had their valuations moderated to some degree. They often act as defensive, not because it's going to lead us up and away and kind of resume the dominance of the market, but just that, you know, the pendulum ought to swing back in that direction, perhaps for a little while.
Well, the Apple selling stopping would be a positive, or at least pausing.
No, you're right,
because that's been sort of a steady decliner as the questions have only gotten greater around that name. NVIDIA's coming off of its big event last week, of course, related to AI, gets a 3% move. Right. Some tariff relief for the other chip names today, too.
So all that fits together. I think semis in particular have really had a bit of a cleaning out type of a trade to the downside. Should point out Microsoft's still underperforming. It's up less than 0.5% on a day when the S&P is up 1.7. So diversity within the Mag 7 is fine. I think it's much more about just how overdone do we get on the downside. We got oversold. We're working some of that off to get us much higher from here. I think it's going to take a little more than just the absence of maximum tariffs. I'll see you tomorrow. That's Mike Santoli.
Bell's ringing us out with another big day of almost 600 on the Dow. We'll see where we settle. I'll see you tomorrow.
Well, that's the end of regulation. International paper ringing the closing bell at the New York Stock Exchange. Huron doing the honors at the NASDAQ. Stocks jumping to kick off the last full week of the first quarter as a potentially softer stance on tariffs re-energizes the bulls. The Nasdaq climbing more than 2%, led by a surge for Tesla. That's a scorecard here on Wall Street, but the action's just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan at CNBC headquarters.
And I'm John Fort, joined today from San Francisco. Ahead this hour, Morgan Stanley's global chief economist Seth Carpenter weighs in on the latest tariff news and the one policy proposal he says is still an underappreciated drag on the economy.
Plus, we will get to the latest read on the home builders when KB Home reports earnings results, along with nuclear technology company Oklo.
And former Intel CEO Pat Gelsinger speaks out in an exclusive interview, his first since being ousted from the company, about Intel's path forward, what he's doing now, and if he'd ever lead a public company again.
But we start with today's market rally. So let's bring in Carson Group Chief Market Strategist Ryan Dietrich and Evans May Wealth Managing Partner Brooke May. Great to have you both here with all the major averages higher by anywhere from 1% to 2.5%. Ryan, I'll start with you because we have the S&P. It looks like settling it out at 57.67, so up about 1.7, 1.8%. The Nasdaq up more than 2% here. Can this rally be believed?
Well, we think so. Thanks for having me on a green day. It's kind of rare here. You know, one of the things, Morgan, that we like about this, what have we seen the last couple months? A lot of selling on Fridays and a lot of selling on Mondays. This is 2 Mondays in a row now. Buyers stepped in. Friday's up 4 weeks in a row. The market's kind of telling us some things, hate to say this time is different, right? The four most dangerous words. But we're seeing strength around those days that were weak. And historically, you tend to see strength around weekends in bull markets. So we like that. Now, the big question, last comment here. Can it keep going? We think it can. I mean, the first half of March is usually quite weak. The end of February is weak. I know a lot of seasonal stuff is out there, but just the over-the-top negative sentiment. I know lots of guests have pointed these things out, but I'll tell you, the anecdotal sentiment, just people I have never heard from in years were reaching out to me a week or two ago saying, should I sell? Should I sell? When you have all the sellers exhaust themselves, like I think we just did on March 13th, which is usually when you bottom in March, we think this rally has some legs to it.
Interesting. I mean, just looking at the Dow right now, we just turned fractionally positive on the quarter and on the year now. Brooke, want to get your thoughts here. Are you as optimistic, dare I say, or constructive, especially given the fact that growthier names are really adding to this market rally right now? I mean, Tesla finishing up 10% today.
Yeah, we are optimistic. We have a year-end price target on the S&P 500 of 6,500, which would be about a 13% gain from where we are today. And we think that's going to be earnings driven more so than multiple expansion. The trick is figuring out what earnings are going to be right now. We're at the mercy of guidance from companies, and it's a difficult environment for them to forecast. When the most recent CEO sentiment survey came out, there was optimism, more optimism than we've seen in quarters. However, they indicated that their biggest concern right now is geopolitical uncertainty. And, a lot of that's stemming from tariffs. So the sooner that we have more clarity, the better off we'll be and most likely dodge a recession.
So, Ryan, along those lines, how much of the down market that we saw recently was about the tariffs themselves? How much do you think was about fears of slower growth and the uncertainty that still hangs over not only exactly which tariffs, when, how much, et cetera, but how responses will play out?
Yeah, John, I mean, a big part of it, I think, was the uncertainty over tariffs. Like we just said, the uncertainty policy indexes are about the second highest or highest they've ever been across the board. And you know what happens? Stocks tend to do a lot better when those uncertainties that high. Why? Because then you get a little certainty like we just got. Okay, maybe the tariffs are a little more targeted. It's still kind of some bigger question marks and answers, but the market clearly liked that. But again, I'm a message of the markets type of investor. 2 Fridays ago, we had 90% of the stocks higher in the S&P 500. Last Monday, St. Patrick's Day, 90% of the stocks higher, 2 days in a row. We call that a buying thrust. 3 and 6 months later, you're talking like stocks have never been lower, right? So with some really strong returns. So to us, hate to say the bottom is in, but we think there's a good chance we bottom right at a 10% correction, middle of March, over the top negative sentiment. And now we're seeing the market tip its hand that the buyers are back in control.
All right, cross your fingers there, Brooke, which leads us to housing with earnings that we've got here in overtime today. With tariffs maybe off in some cases, are the home builders okay to buy into here? With the rate cut picture, though, still uncertain?
I think that it's still too soon. They are cheap. KB Home is trading at about 7 times forward earnings. However, If this is an entry point, you would need to be patient. We saw Lennar report last week, and they indicated that they think the housing market is going to be weak for the foreseeable future. The same will likely be true with KB Home. These builders have to give incentives for buyers, and that cuts into their profits, in addition to the uncertainty around what material costs might be and interest rates. So right now, we're cautious on the home builders. We think there's better opportunities elsewhere.
All right, we'll approach these earnings with caution then. Brooke May, Ryan Dietrich, thanks to you both. Now let's bring in senior markets commentator Mike Santoli to gauge the reliability of this rebound attempt. Mike?
Yeah, John, the bulls sort of in the process of earning back the benefit of the doubt with how this has gone, essentially putting in that low, as Ryan was saying, a little over a week ago. Today, this rally brought us to about a 2-week high, roughly speaking, and then we also went back above this 200-day average. I have a 2-year chart here because I wanted to point out back here in late 2023, October of 2023, you also spent 2 weeks below the 200-day average, had a little bit of a V bottom and then built from there. So it doesn't mean it always happens that way, but you're within the kind of allowable amount of time spent below that longer term trend line where it's not really necessarily a big deal. And as you can see, it's still tilting higher. So far, so good. I wouldn't say that it's necessarily finally proven anything just yet. And also, a lot of divergences have built up in this market. Take a look at the 3 major traditional Dow Jones indexes and how they've fared over the last couple of years as well. So you see that obviously the Dow Jones Industrial Average has managed to stay ahead of the transports, which really have taken this plunge lower essentially to the bottom end of this range over the last 2 years. It allowed the utilities to sort of eclipse them by default here on the lower end with their more stable action. So the way I would look at this is not the greatest macro message for the goods economy. Obviously, travel stocks like airlines have told us things look like they're in a soft patch right now. On the other hand, this is a lot of underperformance where it can just be kind of that gap can just close based on mean reversion if people are feeling less bad about the immediate future of macro here. So I wouldn't necessarily take this as some kind of definitive market top, game over, macro worry is real, but it definitely should keep you on alert as we monitor transports today, which really didn't distinguish themselves to the upside the way a lot of other beaten down groups did.
Mike, overall, is this kind of a tennis match? Investors going back and forth, watching for policy news versus macro data and reacting to that?
It pretty much is, yeah, John. And I think the piece of it that really matters a lot, though, is what got priced into the market implicitly at those recent lows. And if you feel as if that was kind of this compound, kind of driven correction where it was growth scare plus universal across the board tariffs on April 2nd, as well as the momentum stocks can't find a bottom. A lot of that stuff has gotten a little bit better on the margins. It meant that at the lows of 5,500 of the S&P, you probably needed fresh, new, negative news to go much lower from there. So I would say, tentatively, you can basically say right now we've made some peace with the current state of all those factors. But obviously, nothing's guaranteed for tomorrow.
Yes, that we know. Mike Santoli, we'll see you again in just a bit. Now, continuing on this theme, is the worst over for the market downturn and for hand-wringing about the economy? That is the question posed by Morgan Stanley's chief global economist, Seth Carpenter, in a new note. He's going to join us next to weigh in. And later, don't miss my exclusive interview with ousted Intel CEO Pat Gelsinger, his first since leaving that job, about what the future holds for him and for Intel. Overtime's back in 2.